Hello everybody, this is Sabyasachi Paul from Eastern Finances Limited. Now with inflation at 7.8% and interest rates going up, we feel that this is a good time to invest in floating rate bonds. The RBI increased repo rates from 4% to 4.9% in the last 1 month. They took a rate hike of 40 basis points in May, followed by 50 basis points today. So, there are talks that, this can further go up to around 5.5% by the end of this year. Thus, interest rates on all fixed products, corporate fixed deposits, bank fixed deposits, debt mutual funds, they will all go up. Thus, locking your money in some of these avenues at current rates will not be prudent. So, if you see, if we generally we get the maximum return for a tenure of say 3 to 5 years, and suppose you lock in your money at a specific interest rate currently, and then interest rates go up after maybe 3 months, then you will have to live with that lower interest rate for the remaining tenure of 3 to 5 years. So, better way to play this is through floating rate bonds. Now, one of the products which is available in the market is the RBI floating rate bond fund. They are at a 35 basis points markup to the national savings certificate rate of 6.8%. So effectively, it is at 7.15% currently. Now, interest rates for these are generally reset half yearly in January and in July. So, given the kind of repo rate hikes which have happened over the last month, there is every possibility that in July these rates will go up. Now, as far as repo rate is concerned, I feel that 4% rate that was there till a month back were decade low repo rates, which we may not see at least in the near future. So by March 2023, if we see a repo rate of say 5.5%, effectively we are looking at 150 basis points hike in repo rates. This will also have a significant impact on your small savings rates going ahead, and there is every possibility that small savings rates would go up by at least 50 to 75 basis points, at least in the next, I mean, maybe in the next year or so. And to put things into perspective, the 10-year GSEC rates currently they are at 7.5%, and they were about 6% a year back. So they've already gone up by around 150 basis points. And during this time period, there has been no change in the small savings rates. So currently, at 7.5% GSEC, it is actually higher than what is offered by the Senior Citizen Savings Scheme, which gives an interest rate of 7.4%. I feel that this is not sustainable, and small savings rates, they are bound to go up, and the best way to capture the higher interest rates automatically is the floating rate bond funds. Another perspective over here is that 10-year GSECs have already, they have rallied from about 6% to 7.5%, and the way repo rate hikes are taking place, and given the kind of expectations that are there, so there is every possibility that GSEC can go up to 8%. But the government, given the government borrowing program, the tax collections, I don't see 10-year GSEC going significantly above 8%. So, if GSEC were to touch 8%, I think this that will be a very good opportunity to get into government gilt securities, with a tenure of 10 to 20 years. And I think, at those levels, I think this will be an excellent product to accumulate. Thank you.